Hey, good morning, everyone. Marty Mazzora here, Friday, the 9th of September, 2022, with your weekly economic snapshot. And I'm going to finish with a quick look at the equity market as well. In front of you is our PWA General Conditions Index, we call it these days. And it continues to roll over, folks, down 13, suggests quite firmly that we are in or experiencing recessionary conditions, or as I like to say, odds presently favor recession on a go-forward basis versus continued expansion. And per my morning note, that's not everybody's opinion at this point. Our partner BCA Research, their analysts, their equity analysts, are actually forecasting no recession in the foreseeable future for the U.S. And I actually highlighted some of the recent commentary that we actually happen to agree with regard to the consumer, but other factors come into play, both relative to the consumer and relative to other factors that have us, at least per our assessment here, anticipating recession going forward if we're not in one already. So I want to add a little bit to that. I'm going to just four inputs today that I'm going to share with you. Then I'm going to show you some of the latest consumer statistics via Bespoke Investment Group, another research firm, premium research firm who we leverage. And then interesting dynamics in the market, as you might imagine. Big rally today, but we'll get into that here at the end. So with regard to what I want to show you today in terms of the inputs, I want to start with mortgage purchase applications. They continue to decline a few weeks in a row. I think it's 4 weeks in a row now. We continue to go down. Obviously, rate of change continues to go down. So we're getting to some pretty low levels, in the residential mortgage market, as we're getting to some pretty high historic levels, at least recent history, with regard to mortgage rates. Heavy truck sales rolling over. You don't hear a lot of this in the media, but heavy truck sales actually have been really good economic indicators for the most part, as you can see. Beginning to top out here as the economy tops out, then really rolling over. As we move into recession, and you can see it was choppy here. It was actually rolling over before we could spell coronavirus, right? And then coming back down and breaking through our uptrend line here. So that clearly scores a negative for the purpose of scoring our overall index. We are a global economy, so we do mix in a little bit of global data that we think has an impact on the U.S. economy. And JP Morgan's aggregate of the global purchasing managers indices now has moved into recession territory, which is below 50 on a month-over-month basis. So again, that's a negative, and that supports our recession thesis at this point. However, the Institute for Supply Management's PMI are still holding up. There's the latest from manufacturing, which we already went through last week. And then this week we got the services sector PMI, and I touched on that in some length on a recent morning note this week. But it actually ticked up. The consensus estimate was at 55.5. We ended up at 56.9. As I shared with you in the morning note, it's not that great a reading, particularly when you look at the commentaries in terms of what underlies that number. But nevertheless, the new orders, employment indices, that sort of thing, or the sub-indexes are still pointing to growth in the U.S. economy. And that does fly in the face of the PMI that are done by Markit, M-A-R-K-I-T, which is another organization who does a different survey. Their PMIs, both for services and for the manufacturing sector, are in contraction territory. So, contrary to what our friends at BCA think, we're seeing enough evidence that says we should be anticipating recession going forward. Although, as I keep saying, and I'm going to give you a little more on that, we think a relatively mild one. At least that's what we're thinking today based on all the data that is at our disposal. With regard to that, I wanted to pull over yesterday evening's note from Bespoke Investment Group and just highlight that for you. So, they touched on consumer data. They talk about the marginal propensity to consume. As inflation has remained high and consumer income growth has slowed, Monthly data on consumer credit creation ramped up pretty dramatically. Okay, so that statement right there kind of flies in the face of what I was presenting this morning in the morning note. Over the past few months, however, record credit card revolving debt has slowed back toward more normal historic levels. There was also a large decline in non-revolving credit growth, which collapsed from a record print in June to a more modest pace in July, right? So you see credit card debt coming back off the boil a bit, amortization or amortized debt, right? Coming back down a bit here as well. That's good when we think about the state of the economy, or at least the state of the consumer. However, as they say here, credit cards again are fine, but other balances are high, right? So here is your revolving, right? So your credit card debt, and then here you have, other balances. Okay, now when you combine the two, when you combine revolving and non-revolving, you're still below those pre-COVID highs. Historically it's not ultimately a disaster, particularly when you look at the state of the consumer balance sheets overall. And they say here, as consumers try and keep spending with lower income growth, debt growth is the only option, right? We touched on that on our charts, and that is that you have a certain level of inflation. You have wages growing at a certain level that doesn't keep up with inflation. If you want to keep up your spending, then debt growth and saving spend down, of course, is the only options, and the result is higher debt loads. That said, credit card debt is actually quite low versus history compared to disposable income. It hit record lows in the wake of the pandemic and hasn't yet recovered to pre-COVID levels, let alone the peak from the 2000s. Non-revolving debt, like auto loans, is a different story. It's near a record balance relative to disposable income. On a combined basis, they're still below that level and could expand further. So there's room if the consumer is inclined in a relatively tight labor market, which would support that, for the consumer to continue to spend up a bit, even use some debt, and that would be a net positive for the economy in the process. So folks, I'm not pretending that this is a super rosy look or that there aren't some trends to be concerned about. But when you extrapolate this into the future, and I can come up with some real potential negatives, equity markets collapsing, which we think that potential is there, doing a real number on consumer sentiment and what that might mean for the economy and so forth. So in no way, shape, or form are we saying that we're out of the woods or the woods couldn't get more dangerous as we go. But as we sit here today, we're looking at an economy that we think is either in recession or has high risk of rolling into a recession. And we think that's going to be a negative for corporate earnings, more so than what analysts are presently projecting, which has us concerned about the state of equities, notwithstanding today's incredible rally, rather impressive rally. We think that there's real risk that we hit lower lows, but we don't necessarily see it as the great financial crisis of 2008, or certainly with regard to things like tech stocks, the bursting of the tech bubble, bear market. But again, that's it's all subject to change. So interesting stuff, and we are net bearish on the economy going forward, but not panicky by any stretch right here. Okay, so let's just do a quick one on the markets, the stock market, and we'll wrap up, although I want to start actually with the dollar. So I presented another one of our indexes. We call it the Equity Market Conditions Index that we created just a year ago. And we think it captures what we believe are the 12 key points that we should be looking at from a fundamental, and there's some technical in there as well, perspective on the market. Now, a couple of positives were sentiment, which was crazy negative, and that's bullish because everybody's on one side of the boat. And I mentioned that here within the context of this week's move or the last few days. Sentiment was really sour. Therefore, there's room for shifting and a lot of people to come in, say, off the sidelines. The other thing I said that probably a lot of people would argue right in my face about would be viewing the dollar as a positive. A rising dollar denotes tightening financial conditions. It's not good, on a dollar adjusted basis if you have foreign exposure like we do, yada yada. A higher dollar is not good for U.S. exports. It's not good when you translate, foreign earnings back to U.S. dollars. It's kind of, as some people say, it's a rising dollar is a wrecking ball. And here we are saying that it's a positive for the market. And what we're doing is anticipating something here. And I said, when we run the dollar analysis with regard to our equity market conditions index, we pretty much just do a technical analysis. And here's what that looks like. A lot of you video watchers will appreciate this because we have a big rising wedge pattern against big bearish divergences in the MACD and the RSI. And today's rally, which has been more than 1% for the S&P, in fact, right now we don't have a single position in our 35 core position that's actually negative on the day, because we are positioned pretty well for a lower dollar, with the commodity plays and the international plays and so forth. So, as I keep saying, folks, we have huge conviction on a 5-year basis because we think over the next 5 years the dollar actually gets weaker. That's one of the reasons. And it's happening in a big way as I speak at you here today. The other thing I wanted to point out, so that we don't get overly excited about these kinds of rallies, is the short interest in S&P 500. This is the net short interest. Take the longs minus the shorts, and we are really, really short right here, folks. These people are actually making, a lot of these people are making big bets, and we think logical bets that the market has further to fall. But when you short something, you borrow something you don't own, you sell it, you got to pay back the lender what you borrowed. And that's in terms of in this case, futures contracts. If it's a stock, the shares of those stocks. So you got to buy it back to give it back. What you're anticipating here is you're going to buy it back at a lower level, pay less than what you sold it for, and pocket the difference. If it goes against you, you can lose the farm, so to speak. So when you have this kind of setup, you have the potential for some, rip your face off rallies. And we are getting another one today. And I think I said it yesterday. That potential is there. And then the other thing that I pointed out in Tuesday's video, and then again, I think in the written blog, was on the daily chart. Recall that we have this trend line. And when we ran the video the other day, we were right there, and we had a falling wedge, right? And our friends who do just a phenomenal job on helping us understand what's going on below the surface with options dealers, which is a big deal these days, said that they called it the put wall. Support was at 3,900. It could be pretty strong. Below that, oof, it can get really ugly. Get some air pockets down here. And it's bearish below 4,000. But they said, and it looked good to us on the technicals, that if we can get a good move with momentum, and I think that's how I put it on Tuesday, above 4,000, we could get something special to the upside. And we have a nice gap up today, and we're actually, right now, looking pretty good relative to the 50-day moving average, which is pointing upward. So that's short-term bullish, right? So this could have legs. Fed President Bullard tried to get in the way of that today, this morning, and said, folks, I want 75 bips increase for the next 2 meetings, and we're not going away. So if the Fed runs true to recent form, they're going to come in and try to talk this thing back down. So we'll see if they succeed. That weak economic data that I showed you, the weakening economic data, that's actually bullish for the market because that's the sort of data that says inflation will come down and the Fed doesn't have to be as aggressive. I could see that move coming back and testing the bottom of this gap, which would be 4,200, and then dying once again, at that 200-day moving average, if we are indeed still in a bear market, which that's our base case currently. So rally made some sense, as I suggested on Tuesday, though. There's some real downside risk here. So I said if I were a short-term trader, if I were trading this at all, I would probably be content with being somewhat market neutral. So I'd have bets on the short side, bets on the long side, and hopefully hold my own while we get these 1% and 2% moves, and be in a position to do really, really well if we get a break either lower or higher, right? But that's not what we do, right? What we do is we manage long-term money on a patient, smart, good risk-reward basis consistently, which of course does subject us to to drawdowns, we're going to get those. But if we hedge properly and we mitigate as much of those as we can, and then be in a position to really do well, when the market finally bottoms, well, then that's success. So patience is key, but constant diligent work is key as well. And so what I said there is that for us patient long-term investors, we think it gets worse before it gets better, but it ultimately does get better. We ultimately do bottom, and there's going to be some real value created in that process. Okay, and then lastly, I'll let you go. This is the hourly chart, 60-day, 60-minute chart. Remember last time I pointed out this falling wedge and these bullish divergences again. This is we were just coming off of this. We were kind of right in here. This is hourly. Each bar is an hour. We were right in there when we ran this before. Try to do this cleaner here. And we had these bullish divergences forming. So this was pretty compelling. That's why I said it's a really good setup. But I said we are in a bear market. If these things are going to fail, it's going to be during a bear market. Well, it didn't fail. Came out of that. Nice gap up here, which I suspect will get filled before all said and done. In fact, that's our base case, obviously, and some. But so right now, folks, we're coming out of it. Now, really, the proper line to draw here would be this right now, right? Which you could say is a rising wedge. You could do that from here, or you could paint a channel. Charts are in the eye of the beholder, no doubt about it. But we don't have bearish divergences here. So this says that this could gain some oomph or some steam, and we could end the week in some pretty happy fashion for the bulls. But again, our base case is that there are lots of pressures on this market, and we don't think we're another 25% from these levels, like I think it was Deutsche Bank's analyst who I read day before yesterday thinks, or Morgan Stanley's chief strategist who says 3,000 on the S&P. That's 20+% from here as well. That's not our base case right here. It could morph into our base case, but we're looking more at, we think 3,500 levels look really attractive right here as we see the world here today. So it'll be interesting as we move in that direction if we indeed do, or if our sentiment or our assessment changes positively enough. I mean, we could re-engage at higher levels if we think the risk reward supports that. So anyway, enough rambling from me, folks. I hope you have a great weekend. I hope this is useful, or at least interesting to you. And we'll be back next week. Thank you as always for watching and listening. Take care. Bye-bye.